Hi, I'm Satish Ramnathan. I'm the Chief Investment Officer of JM Financial Mutual Fund. I joined finance after doing my MBA from Texas A&M. But before Texas A&M, I actually went to IIT Madras where I learned about mechanical engineering. But I found the field of finance very, very attractive in terms of the dynamism, in terms of the innovation, in terms of different products, the kind of dynamism that is there in the industry. And returned to India after finishing my MBA and have been in finance ever since. I joined a rating company which taught me the basics of finance, and after that I've gone into equities, and I found the journey very exciting and fascinating. I joined JM Financial Mutual Fund in 2020, and we are happy to inform that we have touched nearly 10,000 crores in equity assets, and we have introduced a mid-cap fund during this period as also the small cap fund, and both have grown reasonably well, and we are happy to announce that we would also be launching our large and mid cap fund shortly. Our process follows the geek philosophy, which is the growth in earnings and earnings quality. We are very clear about being growth oriented investors and monitoring the earnings quality and portfolio volatility as well, and that has helped JM Flexi-Cap and large cap and value fund to grow substantially during this period. And welcome to JM Financial Mutual Fund. JM Flexi-Cap Fund is the flagship fund of JM Financial Mutual Fund. It's a all-weather diversified equity fund which has no market cap limits. It's a go anywhere fund. It looks at the best opportunities in the Indian equity market and tries to build up a position there and grow with the business that it invests in. It is market cap agnostic, sector agnostic, and tries to achieve stability through diversification of the portfolio both within the sector and across sectors. And in general, the performance has been satisfactory as we have monitored the volatility of the portfolio. Also, it strictly follows the geek philosophy that JM Financial Mutual Fund follows, which is growth in earnings and earnings quality. And the portfolio has about 60 to 65 stocks to ensure that diversification is achieved, and no single stock exposure crosses 6%, 5 to 6%, and these attributes help the portfolio perform reasonably well during good times and bad times of the market. The specifics of JM Flexicap Fund is today it is diversified across large caps at about 45%, mid caps at about 20%, and small caps at about 35%. And it used to be skewed in favor of mid caps until recently, and before that in favor of large caps. In March 2020, large caps constituted almost 93% of the overall portfolio. Today it stands at 45%. What this demonstrates is the flexibility and agility of the fund to move across sectors, to move across categories of the market, to capture the opportunities that the market may offer. The JM investment process follows the geek model. The geek model is growth in earnings with earnings quality. Across the board, our portfolios ensure that we have companies and managements which are of high caliber and high quality. We do not try to compromise on quality to enhance returns, and we monitor the beta of the portfolio to ensure that the volatility of the portfolio is within check, and it's within the norms applied by a risk committee. We have a detailed research report on many of the companies that we invest in, and the research process is thorough to ensure that we get a bottom-up idea. In our view, the market is likely to consolidate over the next 3 to 6 months, primarily because of valuations and earnings growth being muted. As you are aware, corporate India had a phenomenal growth rate last year, and that was on the back of COVID and several structural issues and reasons. But some of that is petering out, and therefore the base is also unattractive, and consequently the growth is a little muted, during which period we believe that the market is not likely to appreciate significantly, and there could be rapid phases of sector rotation or stock volatility, which is why we have ensured that the portfolios are well diversified with no single stock exposure crossing 5 or 6%. I think the sectors that are likely to benefit from the next leg of growth could be from the consumption side, which has been impacted significantly due to the slowdown in rural India. And we could also see the existing sectors continue their growth momentum, such as in IT, pharma, and manufacturing. But we need to be far more selective than what we have been in the past because of this high valuation and growth momentum that we have experienced in recent times. The biggest opportunity for the fund and the investor is that you get a plain vanilla fund which offers best in class flexibility and adaptability to ensure that risk adjusted returns are favorable. The key risks, as it were, are primarily the equity market risks, and also the fact that this portfolio may be behind certain sectors, may be deficit in certain sectors as it moves towards sector concentration. So that could kind of change the risk characteristics briefly, but our self-correction and self-appraisal process quickly corrects such aberrations to ensure that portfolio performance is within acceptable norms. I think what we need to bear in mind is equity markets have returned spectacular returns over the past 1.5 years. It would be quite unfair to expect these kind of returns to sustain. We in fact believe that the markets will go through a period of consolidation with some volatility because of the global geopolitical issues that are cropping up, as well as a slowdown that we are witnessing in corporate earnings. And consequently, investors should maintain ample liquidity and use the phase of correction and consolidation to build their equity portfolios.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.